This video is a collection of Gary Gensler clips that I've discovered. This is just research on how he thinks. Know thy enemy and know yourself. In 100 battles you will never be defeated. When you are ignorant of the enemy but know yourself, your chances of winning or losing are equal. If ignorant both of your enemy and of yourself, you are sure to be defeated in every battle. Sun Tzu.
About Ether and Ripple. And you can go down. I'm not just trying to pull these out. It's just these are the big five. Well, these all seem to have attributes of that Howey test. Was money given over in 2014 for Ether, Bitcoin for Ether? Was money given to Ripple? Every month they sell another bit of it out of the escrow. Is there a common enterprise? Ripple Labs sure seems like a common enterprise. Or the Ethereum Foundation in 2014 I'm talking about. Is it on the expectation of profits? Well, the Ethereum Foundation offering had a 50% appreciation right in the first 42 days written into the offering. And Ripple, even today, links to 16 market makers in XRP. And they're doing a lot to enhance the value of XRP for the benefit of holders of XRP, for the benefit of their own company, because they own 60 or 61% of XRP. And is it on the efforts of others? Well, in the Ripple case, that feels to be the case. Ethereum sort of evolved into something maybe else, but the Ethereum Foundation is still quite central, maybe not as central as Ripple Labs. So I think there's a strong case, but it's not whether I think so. I think there's a worthy public debate about these issues.
In fact, the controversial statement that you made obviously was that Ethereum and Ripple
wasn't CryptoKitties?
that Ethereum and Ripple might end up being classed as securities. I mean, first of all, there's no reason why you wouldn't know, but do you have a sense of how long it might take the SEC to come to a ruling on stuff like this?
I don't know. I think that I think this is a multi-year process. The reason I say that is to write a rule, get public comments, to get feedback, finalize that rule, give a period of time for implementation, and maybe court challenge is 2 years at a minimum and possibly 3 to 5 years when you really see how things go. I think 2018, and I'll be speaking more about exchanges later this week, but 2018 is a period of time to try to bring compliance into this sort of 1,000+ tokens. On Ripple and Ether, while I think there's a strong case particularly for Ripple or XRP, given the centrality and the common enterprise around Ripple Labs, and that they're selling it every month and so forth, that's really a discussion between them and the SEC. And ultimately, the way I would think is, if the SEC declares that they're securities, it might end up in court. And so it won't be the SEC. It will be maybe not even a federal district court, but an appellate court that will decide, or the Supremes. But let me say this. If they decide that they're not securities, I think that too probably ends up in court. And the reason is because somebody else will say, well, why are they getting out of regulation and I'm not? So law is best when applied consistently. And we went through the Duck test and the Howey test, a little humorous, but it's also because for whichever way authorities go, they have to have an eye on consistency as well.
Right.
And so I think 9 months at the least, maybe 2 to 5 years at the longest.
Right. And so let's say clamps down lots of these things. Essentially, it says, a lot of you guys who issue tokens and a lot of you people who are holding tokens, what you were doing was illegal.
Well, the holders not necessarily.
The holders not necessarily, the people who did the issuance.
The public might have been scammed, but they weren't necessarily breaking the law or anything.
So it's two classes of people with two classes of problems. The people who issued the tokens, are they criminals? What happens to them? And then the people who are holding the tokens, were they scammed, and how do they get redress?
I think regulators around the globe will sort it through, but as you saw in the first of these last summer, the DAO, D-A-O, the SEC chose to write, I think it would be called an order, but they didn't actually then have a civil money penalty. They didn't charge. They just wrote an order and tried to change behavior. I think there is a reasonable case to be made that if you can come into compliance, if the Securities and Exchange Commission gives some number of months, and I don't know what that is right in a period of time, but some number of months or a year or whatever to come into compliance, then they'll look forward. The challenge is compliance is about disclosure. That's hard to do, but it's doable. Compliance is about the manner of sale. You can't change the manner of sale from 2 years ago, but maybe you can change the manner of sale going forward. Compliance is about beneficial ownership. That's a tricky one. Compliance is about anti-fraud and insider trading rules. So, you know, but I think it's more like, let's look forward, and there's 1,000+ horses running on the field that got out of the barn. We've got to kind of bring them into compliance. And even for Ripple and Ether, or maybe it's, you know, EOS or NEO or something, you know. But for the big market cap ones, there needs to be clarity in the market. And if the clarity in the market is that they're not securities, they might still be commodities. They might still need to comply with all those laws and so forth. But I think it's a period of time. But if you do an issuance now, in April of 2018, do it under the U.S. securities laws. I think everybody's on notice now. And Chairman Clayton did that in February pretty clearly. And any law firm advising them, I'm sure, is telling them, we can't write you an opinion unless you comply with one of the exemptions maybe. There are various exemptions if you only sell to accredited investors or other various ways to package these things that still have some burden. They still have costs, and they still have this kind of tricky question of how you figure out who all your beneficial owners are.
Right. So do exemptions, and so selling to accredited investors, the SAF, the Simple Agreement on Future Tokens, which you mentioned. So do you think that resolves the problem? Is that a framework that works within securities law?
Well, I think you're asking two questions. The first is, do I think selling to accredited investors under what's called Regulation D works? Yes, if you comply with all the exemptions and all the requirements of Reg D. Do I think that a SAFT or a multi-staged where you can at one day be a security and a year or two later not be, or in essence will Filecoin's token, not to pick on them, but it's a real case, will Filecoin's token not have to be registered? I think that's unlikely, but they might be successful. I mean, you know, that's for between them and the securities lawyers and the SEC. I think that at the core is the economics. The core is you can be both a consumable token and an investment token, and then you need to comply with securities laws. And if somebody's raising $250 million, as Filecoin did, or $1.7 billion, as Telegram did, and the market is the size that the market is, there's a lot of investors who are investing, and then I think the laws should adapt. There's going to be a lot of changes that over the next 2 to 5 years are appropriate, but it's better to bring it inside of the public policy framework, even if there's a little bit of a chill, but to bring it in to be stronger and reap the benefits later. And I think the internet went through this a bit, and other technologies. Railroads went through it in the 19th century. New technologies usually come about outside of a public policy framework, and at some point, whether it's the taxing authorities or other authorities, they're sort of saying, well, we still want to achieve something. And in this world, we want to protect investors and consumers. We don't want, like, consumers' money to be lost, like $500 million got lost at CoinCheck in Japan in January. I mean, we all remember Mt. Gox 4 or 5 years ago, but you know, this keeps happening. So there's still core public policy goals, and they're still worthy, but then it's sort of adapting the technology and adapting the laws to fit them together.
Great. Well, Gary, we're out of time, but thank you so much for this. It's great talking to you. Cheers.
Thank you. To 80% of the tokens. Ripple is a company that has the third largest market capitalization. When they first started, they kept 80% of the tokens for their own company. That's not wrong or right, it's just a fact, but it's something that gives you an attribute that it's more like a security. They create scarcity through a preset monetary policy. Not quite like central banks, but a monetary policy in the issuance of these tokens. And the development, while open source, is largely centralized. You'll hear debates about centralization versus decentralization. And I would tell you, even Bitcoin is more centralized than a lot of its proponents would like to suggest, but these ICOs are really quite centralized.
Two of my colleagues that introduced you today touted your expertise in digital currencies. I'm proud that crypto companies like Anchorage Trust have found a home in South Dakota. At the same time, I know that our outdated crypto regulatory regime is leading other organizations like the Diem Association to set up shop overseas. What can Congress and the SEC do to create a more forward-thinking regulatory environment for innovators in this particular space?
Senator, thank you for having met with me and for that question. I think as I teach at MIT on these subjects, that these innovations have been a catalyst for change. Bitcoin and other cryptocurrencies have brought new thinking to payments and financial inclusion, but they've also raised new issues of investor protection that we still need to attend to. And so I think if confirmed at the SEC, I'd work with fellow commissioners to both promote the new innovation, but also at the core, ensure for investor protection. If something were a security, for instance, it comes under the securities laws, it comes under the SEC. If there's exchanges that trade those, to ensure that there's the appropriate investor protection on those exchanges. So promote technology, but still stay true to our core values of investor protection and capital formation.
Of financial regulations in such rapidly innovating markets, I think it's very challenging from a regulatory standpoint to manage that type of environment. To put it another way, using a Tennessee terminology, you don't want to be shooting where the rabbit was. My question to you, Mr. Gensler, and it's an open-ended one, if you could share your perspective on the SEC's role under your leadership, if you're confirmed, in how you will approach digital assets.
Senator, I thank you for that opening. I share your thoughts. It's always important to update our market oversight to new technologies, but I believe foremost to be technology neutral. And I say this because if this new technology of cryptocurrency and potentially central bank digital currencies comes along, that it's important to stay true to our principles of investor protection and capital formation, but at the same time be technology neutral. So I think that at the SEC, it's really to the extent that somebody is offering an investment contract or a security that's under the SEC's remit, and they have exchanges that operate there, then we have to make sure there's investor protection. If it's not that, and it's a commodity, as Bitcoin has been deemed to be, then it's either a question for Congress, how Congress would want that to be overseen, or it's possibly a question for the Commodity Futures Trading Commission. But I would work with the staff, I'd work with fellow commissioners and see how we can move forward, and to the extent investors can be protected and invest in these markets, that they're allowed to do so, but to do so in, again, the core function of investor protection and capital formation.
I appreciate your cognizance of your jurisdiction and also, and importantly, the role of the Congress in overseeing this and dealing with it. This is an area where I think we have great potential for leadership if handled right, and I think we should be very careful not to have too heavy a hand, but bringing your experience and your expertise to bear, I think you can make a significant mark in this rapidly evolving market, I want to make certain that we take the right touch and the right coordinated approach between our legislative oversight and the role that you'll play, if you're confirmed, running this important independent agency. Thank you.
Well, I thank you, and if I can appropriate your line about not shooting where the rabbit was, I thank you for that too.
Tennesseans.
Questions in this round for Mr. Gensler, and it's nice to see you again, Mr. Gensler. In some quarters, the SEC has a reputation for being a black hole for innovators. Do you agree that we need to provide more legal clarity through rulemaking and no action letters to innovators in the digital asset space and in the blockchain industry specifically?
Senator, I thank you. I thank you for our conversation in the last week on these matters and others. I do think that technology and markets constantly change and evolve, and that it's important for the SEC to provide guidance and clarity. Sometimes that's a clarity that will be thumbs up, but even if it's thumbs down, it's important to provide that, whether it's through guidance or no action letters, as you mentioned.
I don't know if you're aware of this, but Wyoming was the first in the U.S. to enact consumer protection laws for digital assets, including virtual currency. That happened in 2019. What are some of the ways we can work together to ensure consumer protection for digital assets that doesn't also hamper innovators?
Senator, I was aware. I think that your legislature and governor enacted 13 separate acts in the digital space in Wyoming. I think it's important to protect consumers and investors. One area of consumer protection is around the custody of their funds, digital assets. The actual ownership relies on something called a private key in cryptography, and ensuring that that's really that custody works. And I know Wyoming has looked at that, New York, some other states. I believe actually South Dakota may have as well. I hope I didn't leave out any of the member states. But I think also investor protection, which goes beyond just the custody of assets, but to ensure that these markets are free of fraud and manipulation. And I think that's the greater challenge, frankly, because there has been the markets for some markets usually operating overseas, but some markets have been really rife with fraud and scam. So trying to protect the investors against that fraud and manipulation.
Now, in 2018, you said in front of the House Agriculture Committee that blockchain technology has real potential to transform the world of finance. Could you talk more about how this technology can promote financial inclusion and reduce risk and create new markets?
Well, I think it's already doing some of that right now, that it's been a catalyst for change. Central banks around the globe are really looking at how to provide more inclusive payment structures, more inclusive payment tokens. And so that's in one area as a catalyst for change, but it's also other payment system providers are looking to say, how do we provide payment systems that operate 24 hours a day, 7 days a week, and at lower cost, both cross-border and domestically. Blockchain technology itself is a shared accounting system, if I might say. And I think that's also led to some new thoughts about how to do trade finance and even medical records technology and the like. So I teach it. I'm neither a maximalist nor a minimalist, but I think that it's really been a catalyst for change in numerous areas.
Mr. Gensler, if you would begin first for 5 minutes. Thank you.
Chairman Brown, Ranking Member Toomey, members of this committee, it is an honor to appear before you. 2 decades ago, I served on this committee staff under Chairman Paul Sarbanes, who we sadly lost this last year. And today, I am proud to be here as President Biden's nominee to chair the Securities and Exchange Commission. I have spent my entire professional career in and around financial markets, in the private sector, in state and federal government, and now in academia. And I believe our markets are the finest in the world. But they didn't become that way through happenstance. In the shadow of the Great Depression, Congress created the SEC to protect investors, maintain fair, orderly, and efficient markets, and to facilitate capital formation. In the decades since, we have seen that when the SEC does its job, when there are clear rules of the road and a cop on the beat to enforce them, our economy grows and our nation prospers. But when we take our eyes off the ball, when we fail to root out wrongdoing or adapt to new technologies or to really understand novel financial instruments, things can go very wrong. And when that happens, people get hurt. 12 years ago, when I became chair of the Commodity Futures Trading Commission, our economy was reeling from the financial crisis. My fellow commissioners and I took decisive action on a bipartisan basis to increase transparency and reduce risk in the $400 trillion swaps market. And I am proud that 85% of our actions were passed with bipartisan support. If confirmed as SEC chair, I will work with my fellow commissioners, the SEC's exceptional staff, and the members of Congress to ensure our markets remain the world's best. That means strengthening transparency and accountability in our markets so people can invest with confidence and be protected from fraud and manipulation. It means promoting efficiency and competition so our markets operate with lower costs to companies and higher returns to investors. It means making sure companies, incumbents, and entrepreneurial startups alike can raise needed capital to innovate, expand their operations, and contribute to economic growth. And above all, it means making sure our markets serve the needs of working families. I'm a product of a working family. Senator Cardin was kind enough to say he knew my folks. Neither of my parents went to college, but my father was able to take his mustering out pay from World War II and start a small business that would eventually send my 4 siblings and me to college. That is the kind of economic opportunity that should be available to each and every American, no matter who they are. I believe our markets are essential to providing that opportunity. That's because capital markets touch every part of the economy. They enable businesses to develop new products, build new facilities, grow their payrolls. They help working families save for retirement and invest in their children's futures. And although it may not seem intuitive, when someone goes to take out a mortgage or open a credit card, our capital markets are on the other side of those transactions as well. We cannot take any of this for granted. Markets and technology are always changing. Our rules have to change along with them. In my current role as a professor at MIT, I research and teach on the intersection of technology and finance. I believe financial technology can be a powerful force for good, but only if we continue to harness the core values of the SEC in service of investors, issuers, and the broad public. Before I close, I do want to introduce and thank my 3 daughters, Isabel, who's here with me in Maryland, over there, and her older sisters, Anna and Lee, who are watching remotely. They're the lights of my life, and I wouldn't be here today without their love and support. I thank you, and I look forward to your questions.
By one said, Mr. Howie. The question was they were selling land. Selling land, and the purchasers of the land could then contract with an affiliated company to grow oranges on it. And the question was, is that investment contract and thus a security under the securities law? And the U.S. Supreme Court in 1946 said yes, that was an investment contract. It was part of what Congress's intent was in the 1930s. And it's been upheld at the Supreme Court 3 or 4 times as recently as about 10 years ago. So it's kind of settled law for 70 years. And this is the 4-part test. Sometimes people call this a 3-part test because they put the first is easy as investment of money or assets. Is it a common enterprise and expectation of profits on the efforts of promoters of others? I think that 99% of initial coin offerings pass this test. And by the way, if you're advising somebody, you do not want to pass it, you want to fail this test. But if you pass this test, you are an investment contract, you are a security, you're under the U.S. securities laws. But you don't need to take my word for it. Jay Clayton has said this a few times in front of congressional hearings. And a week or 2 ago, the SEC gave their first no-action letter. Does anybody know what a no-action letter is? I never knew what a no-action letter was when I was at Goldman Sachs, by the way. And if I went to Harvard Law, I probably wouldn't know what it is either. But when I was at the chair of a commission, I knew what a no-action letter is because the lobbyists and the lawyers are always coming in and saying, we just want to do this activity, but we want to make sure we don't think it's under the commodities law or securities law, but could you confirm it's not, and could you issue us this letter that you will take no action to enforce the securities or commodities laws? In fact, if you go into regulatory practices at any law firm, you will be in the no-action business. It's a mother may I business where you walk into a regulator, you explain your client's business, you kind of say, I don't think it comes under the communications law or the securities law, but I'd like you to confirm that. And you get what's called a no-action letter. It's regulatory discretion. It's a regulator saying, we are choosing not to lean in and enforce this bit of the law. We're going to lean back. And I don't know, I got to the CFTC, there were 600 or 700 no-action letters that had existed, and I committed in my confirmation process that we'd make them all public. That upset a few people, actually. And in my time there, we probably issued another 100 to 200. So it's a big thing. But they issued a no-action letter. For the first one, it was a stable value token. It was a custody token on fiat currency. I don't think the SEC is going to let many ICOs off the hook. I think they're going to scare the market and enforce the market, try to bring it into compliance. These are the cases they've brought so far, or actions they've brought so far, but there's 2,000 or 3,000 ICOs that have happened. There's not enough enforcement staff to do more, but you keep bringing these things, and it's slowly kind of bringing the market into compliance. Crypto exchanges lose a lot of money. It gets stolen. These private keys get stolen.